Hello everyone and welcome back to our latest BKL webinar. I'm Anthony Newgrosh. It's a pleasure to be with you again and thank you for joining us for our latest topic, which is on employment taxes. It's been a while, so long in fact, I think Spurs, according to the rumours, have actually won a trophy in the intervening period, so we'll try not to make it such a long gap next time. Moving swiftly on, when I joined BKL, I think it's about 15 years ago now, there are 100 people in the firm in total. We've now got over 100 people in tax, and we're delighted that we've got a couple of our new colleagues from Wilson Wright. One of the reasons we had the merger is because we wanted to invest and strengthen our tax team further. So I'm delighted to be joined by a couple of colleagues I'll introduce in a minute. But because we've got such strength and depth in tax now, we do cover, I'm not going to read them all, but digital assets and cryptos, employment taxes, obviously that's why we're here today, VAT. Hopefully we'll introduce you to our new VAT partner, Luigi, soon. We'll cover employment taxes, merger and acquisitions, properties, and tax risk and dispute resolution. So we like to think that we cover all the bases in tax, and in particular, we now cover employment taxes. And that's why we've got Stephen and Sean here today, who've joined us to head up our employment taxes team. Welcome, chaps. A pleasure to have you on board.
Thank you, Tony. It's good to be here, and thanks everyone for dialing in this afternoon. It's good to see the numbers creeping up as well, and we're looking forward to taking you through today's topic of employment taxes explained. I'll let Sean say hi as well.
Thank you. Hi, everyone. I hope you enjoy it.
Thank you very much, and I'm delighted we've got a special guest star joining us today. We've got Sophie Clark from EMW Law LLP. Sophie, thank you for joining us. Do say hello.
Hi, hello everybody, it's great to be here. I'm Sophie, I'm a partner in the employment team at EMW. We're a law firm, we're headquartered in Milton Keynes, and we provide the full portfolio of legal services covering commercial services, corporate finance, real estate and private client to UK based and global companies. As a partner in the employment team, my practice involves working with corporate clients, dealing with the full range of employment law and HR issues.
Thank you. Okay, so sandwiches at the ready. Stephen, what we're going to be covering today?
Thank you, Tony. We're going to give a brief introduction as to what employment taxes is. It sounds a little bit self-explanatory, but it's worth us just touching base as to all the areas that does cover and what it includes. And then I want to try and give people a summary of what the employment taxes landscape looks like at the moment, the things that are keeping us busy, that are keeping our friends at HMRC busy, very much the sort of hot topics and things that are in our inbox at the moment. Given the time of the year it is at the moment, we can't have a seminar or a webinar on employment taxes without talking about the fun subject of end of year compliance. So we'll spend a bit of time reminding people around P11D and PSA processes and what that end of year cycle looks like for employers. We'll then hand over to Sophie, you just heard for in terms of employment law update, because I always think employment law does sit hand in hand with employment taxes. In so many of the areas I deal with, there are many legal crossovers. So it'll be great to get that sort of update from Sophie. And we're going to round things off, trying to be on a positive note in terms of managing costs and cost reductions and the age-old subject of salary sacrifice, which has come to the fore again, given some of the changes in April. But that's a flavour, and hopefully that should take us through to around about 2 o'clock, and when people can finish their sandwiches.
All right, thank you for that. We've put questions and answers on the end there. You all know how this works. You've got a question and answer box. I think it's in the top right-hand corner of your screens. If there's anything you'd like to ask, do feel free to type your question in there. We'll try and take those as we go along. Apologies, we may not have time for them all. We will, though, be sending a copy, both of the slides and a link to this webinar. And if there are any questions we haven't covered during the session that we think are of general interest, then we'll send a few extra answers there as well. But we'd be very grateful for your comments and questions. So do feel free to type away and we'll do our best as we go along. Okay, as I think Stephen, you were alluding to, employment taxes, perhaps not the most glamorous of taxes, as it were, in the world. But I think I've said the wrong thing, haven't I? But I think if we have a look at this slide, it really should grab our attention. Give us the headlines, Stephen.
I've often used this this graph, this pie chart, to somehow justify my self-worth and the importance of the role I play professionally. If you look at the two slices of the cake on the left-hand side there, they represent national insurance contributions and income tax, the majority of which, for both NIC and income tax, represents pay-as-you-earn and Class 1 NIC. There's also Class 2 and Class 4 and income tax via self-assessment, but those are much smaller slices of the chart. But what you can see is that over half, 53% of total HMRC receipts are employment taxes. So we are a vital part, we play a vital part in terms of UK PLC. Because I'm slightly biased, I would say a more important part than my colleagues in corporation tax and VAT, but that's with my tongue very firmly in my cheek, of course. But that's why it's an important part of the jigsaw as to why we feel it's important to be having these webinars, because we play a very vital role in keeping the country moving forward in terms of that tax revenue that's coming through to HMRC.
Stephen, I know we've got a lot to cover, but strictly is NIC is it a tax? And now we're not shackled by the EU. Should we just go the full hog and just wholly align it with income tax? Any quick views on that?
This is the age-old question: is national insurance? Well, given that I cut my teeth originally in the Inland Revenue, as it was, and I was trained very much by people who were formerly of the Contributions Agency, showing my age now. So they would certainly take issue with saying that national insurance is not a tax, because it's founded in the contributory principle and goes back to the welfare state. But in all but name, it is a tax, because it is collected in the same mechanism as income tax via PAYE. They have looked at before at merging both income tax and national insurance, but they're two very separate pieces of primary legislation that have grown up over a very long period of time, and successive governments, when they've looked at that, have very quickly backed away and realised it's a little bit too difficult to do. Never say never, but for now, it technically isn't a tax, but certainly looks, feels, and sounds like one.
Fair enough. Okay. And when we talk about employment taxes, this really covers a huge area, and obviously we've not got time to delve into everything today. But do you want to give us just an overview of the tax landscape here and what it covers?
Of course, and as Tony says, it is merely an overview. This is a summary of the sort of services and offerings that we can provide Wilson Wright and BKL around employment taxes. I like things that are quick and catchy, so I've called this the 4 C's. So they break down into a quadrant of compliance, consulting, cross-border, and cost savings. And compliance is very much what it says on the tin. It's the sort of regulatory, the legal requirements that employers have to ensure they do. And we're in that time of year now, so we'll be covering things like P11Ds, PSAs, but there's a few other things there as well. Cross-border is everything to do with the movement and taxation of internationally mobile employees, whether those are short-term or long-term assignees, and the compliance and the reporting of that. So there's some crossover. Consulting, I find the most interesting area of our work. It's where we're usually brought in to sort of support on some quite large projects that could be the taxation of consultants or IR35, but we could also be looking at the treatment of worker types around national minimum wage and what you need to do to ensure that you comply with those rules. I will be finishing the webinar today on that cost saving piece, so particularly because of those April increases, which we'll touch on in a moment. But if there's ways which we can, within the rules, help employers reduce their overall tax burden or NIC burden, typically via salary sacrifice, but there's a few other things we can do. That's something we'll be pleased to support on as well. But I'm calling the 4 C's, and it's a quick summary of what we can and hopefully will be doing for our clients and stakeholders in the coming months.
Okay, well, you mentioned the April increases. Maybe that's the place to start. Absolutely,
and this will be on the top of everyone's mind, because we've just come out of the 24-25 year end, and it was not just a double whammy, it was a pretty triple whammy, to be honest. We had the increase of 13.8 to 15% for employers NIC, and it's getting close to the level it was under a previous administration. But unlike that previous level, what we have now is that reduction in the secondary threshold. It's going down to £5,000. So that and the increase in employers, Nick, the secondary really is quite painful for larger employers that particularly have quite significant labour costs. They've tried to take the sting out of it a little bit with the increase in the employment allowance up to £10,500 per year, and that will benefit a sizable number of employers, but not all. It's worth remembering. So if you've got total employer NIC liability of 100,000 or less, you will benefit from that increase. But it comes on the back of not just those changes around NIC and the threshold changes, but also the national minimum or the living wage. That changed from the 1st of April as well. So that's now increased to £12.21 per hour. And that is the living wage. But then for the lower age categories, you've got the national minimum wage. It's also been increased, and they're tracking just below what we sometimes call the real living wage, which are figures that are put out by something called the Living Wage Foundation. These are not the statutory rates, but it's £12.60 and £13.85 in London. So those aren't the statutory rates, but we're getting quite close to those, and these are recommendations that are made by something called the Low Pay Commission annually, and those are the rates that are there. But as I say, it's a bit of a triple whammy: the increase in national insurance, the reduction in the threshold, and the increase in national minimum wage, all coming at the same time. And you would have seen today, the results of a survey from the Office for National Statistics. It's confirmed in the 3-month period to May this year, there are now 63,000 fewer vacancies out there. So it is already having an impact on the labour market. There are fewer job vacancies. As part of that survey, they sort of asked what the reasons of that, sort of qualitative rather than quantitative feedback, and it appears that employers are less quick to replace staff that might be retiring or leaving through sort of natural attrition rather than wholesale reduction in headcount. But the numbers are, in a downward trend in terms of vacancies, and that I think can be linked clearly to what we're seeing there in terms of the increased costs coming through from April.
Yeah, not good news, I'm afraid, and I guess there's no real way we can sugarcoat that. But yeah, 15% headline rate of employers NIC, I guess. So that's, I guess, relatively new. One area that's been around for a while but continues to cause difficulty is IR35. Do you want to talk us through this one, Stephen?
Absolutely. My favourite of all the IRs, the 35th one. And whenever I talk about IR35, I always like to go back to where it all started, which is when it was announced in 1999 from the department that announced it, which was the Inland Revenue, the IR, and it was the 35th press release from 1999. So that's where the name comes from, IR35. Has nothing to do with legislation or any sort of references.
I didn't know that. Thank you, Stephen.
A lot of people don't know that, but I like to throw these fun facts in, Tony, to try and keep what some people consider a dry subject fun and exciting. But this is fun and exciting to me. In recent years, it's sort of moved away from being referred to as IR35, although people in the profession will always call it that, and they're using this term off payroll working or off payroll workers, OPW. But I put an infographic here just to sort of understand what it is and paint a bit of a picture. It's effectively someone who's being paid gross outside of payroll for services that they're providing, and for IR35 to apply, there would need to be an intermediary between you as the end user or the fee payer and that worker. That intermediary is typically going to be a limited company, sometimes referred to as a PSC, which stands for a personal service company. And the way the IR35 legislation works is it asks the question: if we remove this limited company in the graphic, a triangle, if we remove this limited company from the supply chain, would the worker be an employee? Yes or no? If the answer is yes, then IR35 applies. That person is deemed inside IR35, and they should be treated, from April 21 anyway, as an employee for tax purposes. Sophie will jump on me if I say they're an employee for legal purposes, because they're not. They're only an employee for tax purposes. But if the answer is no to that question, they can be paid gross outside of payroll, genuinely self-employed, and that's what outside IR35 is. And as Tony mentioned, this is not an issue that's new. It's only really come to the fore in the last few years because the rules were updated in April 21, so that responsibility for determining the status of the worker flipped from the individual themselves, the PSC, to the engager, to the end user. So they are responsible for both, well, two things really. Number one, carrying out that status assessment. And then number two, once they've done that assessment, if someone's inside or outside, potentially putting them on payroll. And because of the April 21 changes, it's been here for 4 years. We're now at the point where if HMRC were to come out next week and do a review around your contractors or people who are treated off payroll, they could, in theory, if there's an error, collect up to 4 years of tax, which are the normal time limits. So there was always a soft touch year or two where HMRC were letting employers sort of get their head around the new rules. We're sort of past that point now. We're in that sort of normal time limits. So HMRC are expecting people to have good governance, good controls, and the key phrase here, which I've put in speech marks here, is making sure that you're exercising reasonable care. Make sure you exercise reasonable care, and you can evidence that you're reasonable care in how you assess and determine status for any people who are treated off payroll. But those are the sort of phrases you'll hear thrown around by people like me a lot, inside and outside IR35. But what that really means is, if we took the PSC away, sometimes lawyers call it piercing the corporate veil, but if you took the PSC away, would that worker be an employee or not? That's what inside or outside IR35 means. Of course, I mean, if there isn't a PSC and it's someone who's just engaged directly, it could be an individual, a sole trader. You have to carry out the same tests anyway. This only really applies in terms of the IR35 rules if there's an intermediary, but under the first principles, if it's direct engagement, you need to be carrying out the same sort of checks. It's just not as formalised in terms of the processes and the status determination statement, the SDS.
Okay, I mean, you did just one of the points, Stephen. You said when we were talking about the intermediary, you said it's typically a company. It doesn't have to be a company, does it?
No,
the intermediary
no.
could be, a partnership, for example.
Absolutely. I mean, the most common form of intermediary we see is a limited company, but it's not defined that way in the legislation. So it could, in theory, be, like you say, a professional partnership or an LLP. But the most common one we see is a limited company. Okay. And what we're trying to do to determine if that is a personal service company is trying to see, is there a director that is a person of significant control? Another PSC abbreviation, just to confuse people. But if you've got a director who's a person of significant control and they're providing their services personally, that's what meets the hallmark of a PSC. But we have got another slide on this as well, because I think it is an important topic, and some of this I've sort of touched on already, but we put that link there to a news report I saw last month around HS2 are investigating two firms in their labour supply chain around the categorization or the miscategorization of their staff. So I include that really just to say this is, very topical, and you do sometimes see these large corporate bodies, sometimes public bodies, that often inadvertently fall foul of the IR35 rules. And unlike other areas of employment tax, if you make an error in relation to status or the categorization of workers, it can be very costly, because if you think about a failure to operate, it would be a pay-as-you-earn, national insurance, employees and employers, interest and a penalty, times the number of workers, times the number of years. So it very quickly snowballs. So the best thing to do is make sure that you get it right at the outset. I've sat in on a lot of HMRC reviews and inquiries and interventions on both sides of the table, because I used to work at the Revenue many years ago, and it's probably the number one area that comes up under employment duties, the area of employment taxes. It's the number one risk area that HMRC tend to focus in on, because they know that that there can potentially be a lot of PAYE on the table if an employer has made an error, and not just HMRC inquiries. We support on a lot of deals and transaction work and companies on buy or sell side. This is probably, again, one of the number one risk areas around the treatment of consultants and off payroll workers. So it's far better to get everything right up front in terms of any HMRC activity, but also any potential buy or sell side in terms of DD activity further down the line. So you want to make sure you've got good controls and that your house is in order at this stage, rather than being reactive later down the line.
All right, you've highlighted some of the key status tests and indicators there. I know we could do a whole webinar on this alone, I guess, Stephen, but just you've highlighted, I think, three of the most important ones there for us. Yes,
these are the big three, or the top three. And when I learnt status many years ago, and I was still in short trousers, we learnt this almost via a triangle, three sides of a triangle: control, personal service, and mutuality of obligation, which we sometimes call MOO. And that wasn't my impression of a cow. We actually call it MOO, MOO. And I remember always being told, if you cover up one of those areas, you've still got two, that's enough for employment. If you cover up two, it's a little bit difficult to argue employment. It's more of a borderline case. But those are the big three. Those are the primary tests. There are secondary and tertiary tests around provision of equipment, integration, intention of the parties, all those, you know, important factors. But the big three we look at are the control over the worker, who is telling them what to do, when to do it, where to work, how to work, but crucially, can that person be moved from task to task? That's what we mean by control. Personal service, did they have to do it? You know, if I wanted to, you know, send a substitute to come to my job at Wilson Wright, who was equally qualified in employment tax, and you know, my cousin James is very good at tax. If I wanted to send him to my desk one day to do my work, I think the partners at Wilson Wright would rightly have something to say about that, because I work under a contract of employment and it's very much my personal service that's required. But someone who's self-employed, working under a contract for services, they have that freedom, that unfettered right of substitution, as it's called. So really understanding what the rights and responsibilities are around personal service and substitution are quite key to that. And ensuring if there is a substitution clause, does it have teeth? Has it been exercised? If you've had someone who's been there 3 or 4 years and they've never sent a substitute in their life, you know, is that a legitimate substitution clause, or is it just there to contrive self-employment? So really think about those things. And mutuality of obligation is really just the ability to give work and refuse work, or if someone refuses work because they can't do it, but then they're subsequently offered it, they're less likely to be a mutuality of obligation. Whereas if someone's continually offered and accepts work and they're paid a fee for that, that starts to look and feel a little bit more like employment.
Yeah, fair enough. And there's the revenue cess tool, isn't there? If you want to try and test the theory.
Yeah, and the cess tool, it is much maligned, but I have a bit of a soft spot for it, because many years ago I worked on an earlier version of it. It used to be called the Employment Status Indicator, ESI, then it became the ESS, and now it's the cess tool. And it has got better. It's iterative, and they do make improvements to it all the time, as and when case law comes through and tribunals go one way or the other. So do use the cess tool. You can do it on a no names basis, so you're not, you know, putting your company name or your pay as you earn reference on it. And it just gives you a flavour for the sort of questions and what you need to be aware of. But if it does say someone's self-employed or outside of IR35 and you've put good information in and it's accurate, HMRC have said they will stand behind the cess, so they won't challenge it if it is accurate and you put good data in. So I always say to someone, even if they've got their own checklist or they're using another form of determining status, do assess in terms of belt and braces, just have it there, because if you've got it on file and it's correct, HMRC won't challenge it. So, you know, it's good to a point, but the more complex and the nuanced engagements tend to can raise sort of questions. So seek advice, consult where necessary if you've got those more complex scenarios. And if you've got people who've been engaged for a long period of time, so if I say 12 months or more, always reassess them, go back to the cess. Don't just put it in the drawer and forget about it. If someone's working for you year after year, you know, it's worth reassessing them, because the risk profile will change the longer someone's engaged.
Okay, I mean, the one point I would add as well, so if I don't have any views on this, obviously the legal contract is going to be very important here, and it is important you have an agreement, one, that reflects the reality of the relationship, and two, let's make sure it doesn't change, because a contract can say one thing, but your relationship may evolve over time. So is this a sort of area you can help in again?
Yeah, absolutely. And you're on the nail there. It's really important that the contract actually reflects the reality of the working relationship. We see a relatively high number of contracts which are put together, deliberately so in some cases, to present a picture which invariably will change over time. So it's really important that the contracts are, one, right from the get-go, but also that they are kept under review, and as necessary they are then amended, so that if there is an investigation, we can show that we've taken the right steps.
Yeah, and I have to say, sometimes they're a little contrived, aren't they? People seem to think, well, we'll put in the contract, you know, no right of substitution or similar, and think, there you go, we're done now. It's the reality that's important. Yeah,
or a well-intended right of substitution, but perhaps in the background thinking we're never going to use it.
Absolutely. Okay, Stephen, I think the one point you didn't mention was just the exemption for small companies. We've had a question on that. Do you want to just cover that off for us, Stephen, and then we'll move on?
This is timely as well, because the rules have changed very slightly in terms of the thresholds around this from April 25. So there's 3 elements to the test. If you're a small company, and if you are a small company, you can happily revert to the pre-April 21 rules, where it's actually the PSC, the director, that's responsible for determining if they're inside or outside of IR35. So they carry out the assessment themselves. But if your turnover is more than 15 million, you've got a balance sheet asset of 7.5 million or more, or 50 employees or less, you are regarded by HMRC as a small company. So if you meet 2 of those 3 criteria for 2 consecutive financial years, you are considered small. But as soon as you breach those, again for 2 financial years, that's when you are a medium company for tax purposes, and you would have to start operating the IR35 rules, and you are responsible for carrying out those assessments. So yes, check those rules, apply them to your own balance sheet and P&L, and then determine where you sit in terms of IR35 assessments.
Okay, all good. All right, let's crack on. We're in the post-COVID era, and home working, I guess, is here to stay. But this does raise various employment taxes issues, doesn't it, Stephen?
Yes, and it's interesting you talk about post-COVID, because during the pandemic, we really did see a sort of wholesale change in the way businesses, employers, and companies operate, and there's been a bit of a continuance of that in many businesses, where people will often work under these hybrid arrangements now. And there's just a few things, I suppose, to be aware of in terms of not just the employment tax, but there's some legal considerations here. And again, I won't step on Sophie's toes, but if someone is working permanently at home and not coming into the office, or they're only coming into the office for ad hoc purposes, for ad hoc meetings, and there's no requirement to, there has been a change in their permanent workplace. So has that been reflected in the contractual changes? It's important for things like travel expenses, because travel to a temporary workplace does attract tax relief, but there's all sorts of complexities between where someone's home is their permanent workplace and they're coming into an office. But is that office, if they're coming there for more than 40% or 1 day or 2 days a week and they're required to, you could have a scenario where people have 2 permanent workplaces. So just thinking about what people are claiming or they aren't claiming in terms of travel expenses, or particularly people who may have moved a long way from the city where they're based. I saw a vast exodus of people moving to the West Country during the pandemic and then coming up to London as and when for meetings. But just thinking about what that looks like in terms of their contracting position for the definition of permanent workplace, what they are and what they're not claiming, but also thinking about updating any internal expenses policies. The HMRC guidance doesn't have many examples really around this kind of hybrid and remote working, and I'd say it reads very much still like the 1990s and early 2000s, and I suspect the humble 490 book, as it used to be referred to, does need a few more examples around home working and hybrid working. That's very much the domestic side of things. We also see people now with the ability, because of technology, to remote work overseas, and a lot of companies are introducing policies that allow people to work overseas for sometimes a week or 2, sometimes longer. And again, it's just worth bearing in mind other wider tax risks around having people operate across border in other tax jurisdictions, and potentially the risks that creates, possibly in terms of local payroll withholding, but also the permanent establishment risk for corporation tax purposes. My sense is if it's for a short period of time, it's going to be on the lower end of the risk scale, but it's worth bearing in mind. And often I've worked with companies that they don't find this out until maybe 3 or 4 months down the line when they're looking at expense claims and people have just gone and done it. So having a policy that sort of allows people to understand what the rules and their responsibilities are, and maybe a list of jurisdictions as well. I also seen where people can work remotely, because it's easier from a tax and a social security and a permanent establishment risk. But these are some of the things we're sort of seeing coming through now in that kind of post-COVID way, because we are working very differently now to how we worked 10, 15 years ago. So if I don't know if there's anything from a legal point of view you want to add to that, because I'm conscious that a lot of what I was talking about there is the contracting piece.
It's funny though, we're actually seeing as a team a trend now towards going back to office-based working. I don't know what everyone's experiences is of that who are on this webinar, but we're now being frequently asked to advise on bringing teams back into the office. But yes, turning back to hybrid working, absolutely. Make sure that the contracts accurately reflect the current place of work, not least because of the issues it can attract with expenses.
Thank you, Sophie. And Stephen, we talked about staff going overseas. That brings another tax issue to the fore where, well, I think possibly some good news here, isn't there?
I think good news for employers that have internationally mobile staff and have been applying for something called a Section 690 direction. Again, it's a long-standing concept and principle around mobility issues, but it's effectively an agreement with HMRC that you would only tax an overseas employee that's working cross-border in the UK on their UK work days. You provide an estimate to HMRC where you track their days of arrival and departures, and once you have that Section 690 direction agreed and in place with HMRC, you operate PAY on that proportion of their UK income. In the absence of that, it can be a much more onerous process that you might need to tax the whole income, and then the employee claims relief under the double taxation treaty and has to file a tax return. So it is an easement of the rules. The reason it's positive is because the application process has been streamlined a little bit now, and there's an online portal. And I've worked with a couple of clients since I've arrived here, and they've all noted how quick the turnaround has been. So that is a positive step forward, and you can actually apply once you've got that confirmation acknowledgement back from the revenue, whereas previously under the old regime you were often waiting weeks, sometimes months, to hear back from the revenue. So that is a positive development, but something to be aware of if you've got people who are based internationally and they want to claim that overseas workday relief or the Section 690 direction. The portal is now online, and that should be the way in which you interact with HMRC now around these directions. It's not a paper-based application anymore. Everything's sort of moving online.
Good. Okay. Stephen, thank you for that. Sean, I think you're now going to take it forward and talk to us about year-end compliance and those beloved P11Ds.
Yes, precisely. Thank you very much. So yes, as Tony said, I'm going to talk through P11D forms and end-of-year compliance. So I'll first off start off by explaining what a P11D is. And a P11D is a form. A P11D is a form that is submitted to HMRC to report all. Sorry. There we go. Sorry, I was hearing some feedback there. To report all taxable benefits. Typically, we see these as company cars. The most popular benefit that we see reported on a P11D is private medical or interest-free loans over £10,000. And the other way that benefits can be reported is through payroll, and I'll come on to that slightly in a minute. So each employee will receive a P11D reporting any benefits that they may or may not receive. If they don't receive any benefits, they won't be on a P11D. And separately to that, the employer will submit a P11D-B, which is a summary of all the amounts included on the P11D. And that will report the Class 1A NIC, which for this year is 13.8%, but as we referenced earlier, will go up to 15%. So for P11Ds submitted next year in respect of the 25-26 tax year, the Class 1A NIC will be at 15%. P11Ds were due to be removed from April 2026, and all benefits were then going to have to be reported on payroll, except for interest-free loans and accommodation. This change is now being pushed back to April 2027. So it gives another year of P11D completion, and it allows sort of employers to get used to payrolling. But we would strongly encourage that that our clients and employers do register for payrolling of benefits and move towards payrolling of benefits, because it is coming and P11Ds are going to be going out. And we often find that there are some common pitfalls on completion of P11Ds. So if we can just go into the next slide, Tony.
Yep. And some common pitfalls of P11Ds will be, typically they relate to company cars, and how they're being reported. Are we making sure that we're using the list price of the company car? Are we taking into any additional extras that may have been paid for? Are they pool cars or vans, and making sure the correct percentage applies to electric vehicles? Is the car
not available to the employee for any period of time? Has it gone in the garage, etc.? Has there been a replacement car? And where applicable, if the employer is also covering the private fuel, is that being included on the P11D and the private fuel using the fuel scale charge? Secondly, another common pitfall that we frequently see is the trivial benefit exemption. So the trivial benefit exemption applies where you give a gift to an employee of under £50, inclusive of VAT, and that isn't a reward for performance of duties or a thank you, and it usually applies to, we see it typically applying to gifts that would be for a wedding, potentially flowers for a funeral, or a new baby, new birth, present to either parent. And we can sometimes see that that exemption might not be being applied strictly correctly, and it's just important to know that what actually applies for that exemption to be in place. Separately, we also see staff entertainment. So we see a lot of staff entertainment. A lot of firms now have Christmas parties, some have summer parties, and then there is an annual event exemption. Again, looking at the annual event exemption, it's up to £150 per head, inclusive of VAT. We look at who attended the event, not just the staff. So we would include, some firms would allow staff to bring their partners with them, so we'd include them in the head count. And we look at actually what that event is for. So you can't simply have 100 staff attending and then invite 3 clients and say, actually, it's a client event. So we want to look into the detail of what was the principal purpose of that event. And another frequent one that we see is interest-free loans and low interest loans over £10,000. How are they reported? How they looked at, making sure that if you have directors' loan accounts, that the correct amounts are being included up to the 5th of April. And that also includes salary advances. So, it isn't just one loan. We do have to look at other aspects there. And now I'm going to come on to the other items there under the next slide on PSA. But it's important to show under P11Ds that you make sure that you have that documents, evidence, and what's in place, what's being reported, why hasn't things been reported. And again, with that comes expenses and benefits policies. It's no good if you have an expenses and benefit policy that is 10, 15 years old and pre-COVID and doesn't actually reflect what is going on in the current practice. It's the first thing that HMRC, if you're lucky enough to be have an investigation, it's the first thing that they'll look at. They'll ask for policies, and so it's important to make sure that they are up to date.
Okay, I mean, just one thought on that. I saw an email that came around today about interest rates going up on overdue tax, but the official rate of interest, I think, is still only 2.25%, isn't it? It's remarkable that's never been uplifted.
It's now 3.75%.
Okay.
And this the 25-26 year is the first year in which that interest rate can be increased in year. So previously it was set for the year and it wouldn't change, and now it can be changed or looked into quarterly. So again, it's important that clients keep on top of it and make sure that loan account is tight, and if they are correct, calculating the interest, that they're keeping up to date and on the interest amount and looking and checking it quarterly.
Okay, thank you. Okay, you mentioned PSAs there, so I think let's just dig into that a bit deeper.
Yes, so PSA, or a PAYE settlement agreement, you can see why it's been abbreviated, is to cover the tax and national insurance on a grossed up basis for minor, irregular and impractical benefits. Typically, this includes small gifts that we said wouldn't fulfill the trivial benefit exemption. So if you had a gift that someone has just got married and you decided to provide them with a hamper of costing £150, you would typically include that under the PSA. While it could be included under the P11D, it would be the employee might feel a bit aggrieved if they got a gift and then were subsequently taxed on it. Other items that we typically see is events and staff entertainment. So again, Christmas parties in excess of the annual events exemption, summer parties the same, and we again look at, you know, when completing a PSA, you look at the exemptions that could apply to these, either the staff gifts, staff annual event exemption, and take that into account. The other items could be relocation. So if you do have overseas employees that are relocating to the UK, there's exemptions there for their costs. Any excess of those amounts could also be included on a PSA. So it is important to sort of stress that it is on a grossed up basis. So the employer bears the tax costs and effectively bears the tax on the tax. So if you do have an employee sort of basis that hire an additional rate, the amount that you pay under a PSA could be significantly higher than if those amounts were reported under a P11D. You know, because it's grossed up at say 40 or 45%, and that's important as well. We look at the rate bands and the employees' rate bands at the 5th of April and take those into account when preparing the PSA.
Okay.
The PSA, there's a strict deadline to apply to enter into a PSA, which is by the 5th of July. There isn't any statutory deadline to submit it, although sometimes HMRC have previously said the 31st of July, sometimes it's been the 31st of August, but the payment amount of the tax liability in the Class 1B NIC is by the 22nd of October. So that for PSA, sort of that date of, as long as you've got the application in by the 5th of July, you don't need to send an application every year. It's an ongoing agreement. It's just that those amounts need to be paid by the 22nd of October.
Okay. Thank you, Sean. And then finally on our year-end compliance, a couple of quite technical areas.
Yes, and we won't do as deep a dive around these two areas. And again, I'm conscious of time here as well, but it's similar to what we were talking earlier about people who work internationally and cross-border. The short-term business visitor agreement, STBV, or the Appendix 4 agreement. It's a method of tracking short-term business visitors that are coming to the UK where there may otherwise be a technical pay-as-you-earn liability from them for day one, but if we able to include them on an STBV agreement with HMRC, that you won't need to operate PAYE and the employee won't need to submit a tax return to try and claim that relief. There are certain criteria for it to apply. It has to be from a country where we have a double taxation treaty, because the STBV is actually giving effect to a DTT. That's how it sort of works. But the application for them for the closed tax year was the 31st of May, so that was just gone by, but there's no reason why you can't get in early and apply for next year. But the key thing here is about tracking those business visitors who are coming from overseas, their date of arrival, their date of departure, visitor books, visit logs. There are apps that do this now online, but the STBV is something that, again, HMRC look at in terms of your overall compliance profile to assess how you're sort of taking your PY obligations. So that's the STBV. The other one I'm going to mention briefly, again, linked to the 6th of July deadline, P11Ds, is the employment-related securities form. So this is the annual return that's submitted to HMRC where you've got employees that have been provided with shares or share options or any other sort of equity-based remuneration or incentives that have gone to employees or directors. This is the form that you have to capture and return to HMRC annually, even if there have been no movements. And you know that a lot of nil returns still get submitted, and those are required to HMRC. And we can support with both these forms of compliance, both the STBV and the ERS form, which is keeping Sean busy at the moment because we're approaching those deadlines. But they cover both tax advantage and not tax advantage schemes. But those are the last few bits of compliance that we wanted to talk about.
All right, and just in my experience, these employment-related securities, the Form 42s, they're often missed. And although I think HMRC have given it a fairly light touch as far as penalties, it's a sort of issue that comes up in due diligence when you're looking to sell the company and they found out they've not done these forms for 6 years, and all of a sudden everyone gets a little bit excited about the penalties. So it is important. And suffice to say, if you've any queries on any of these matters, the clock is ticking. 6th of July is 4 weeks away. Stephen, Sean, or our colleagues who assist in all these areas, we'd be more than happy to help. So, okay, Sophie, I think it's over to you now. Thank you very much again for joining us. I think you're just going to talk us through some employment law aspects that dovetail into what we've been talking about today.
Yeah, absolutely. So much like employment taxes covers a huge area, as does the Employment Rights Bill. And today I'm just going to take you through just a small handful of the reforms that we're expecting. So published in October last year, introduces a wide range of measures which look set to reshape employment law. Whereas the bill now, it's currently relatively slowly progressing through Parliament. What we do know is that many of the changes won't come into effect until next year. So firstly, looking at unfair dismissal. So as you'll probably all know, as it stands now, an employee needs to have worked for 2 years continuously before they have right not to be unfairly dismissed. And there are no rules for probationary periods. Now, the bill seeks to change that position by making protection against unfair dismissal a day one right. Now, not quite as onerous as it sounds, there will be a right for employers to dismiss employees provided they follow a light touch procedure during an initial period. So what's the initial period? Well, frustratingly, we don't yet know. There's going to be consultation about it. There's been talk of anything between 6 and 12 months, but the government has said it has a preference for a period of 9 months. And what's the light touch process? Again, we don't know. It's going to be subject to consultation, but I think what we can expect is there will be at least a meeting with the employee where the concerns are set out. And likely the employee will have the right to be accompanied. Now, the process is expected to apply where the reason for dismissal is capability, conduct, illegality, or that lovely catch-all, some other substantial reason. It won't apply to redundancy dismissals. What the bill has clarified is that there will be no right to a claim for unfair dismissal where the employee has entered into a contract, but they've not actually started work. Now, because of the extensive consultation, as I say, we're not expecting these changes to come in until at least autumn of next year. The other big changes in relation to statutory sick pay. Now, this may change this year, and there has been talk about it coming in from October, but that's yet to be confirmed. So as you all know, statutory sick pay currently is payable from day 4 of sickness absence, and employees need to be earning above that weekly lower earnings limit to qualify, which is £123 at the moment. Under the bill, statutory sick pay will be payable from day 1 of sickness, and that lower earnings limit will be removed, meaning that all eligible employees, regardless of earnings, will be entitled to receive SSP. For those earning less than the lower earnings limit, they will be entitled to SSP at a rate of 80% of their average weekly earnings. The other big one is restrictions on fire and rehire. So I'm sure you all know the Code of Practice on fire and rehire, or dismissal and re-engagement, was put in place in July last year. The purpose of that was to put in place a framework around information and consultation obligations where employers are intending to make changes to terms and conditions of employment and where dismissal and re-engagement is contemplated. And that Code of Practice applies wherever it's contemplating, regardless of the numbers of employees. So it could be 1, it could be 100, the code will kick in. So that practice at the moment remains lawful, albeit plainly it's relatively high risk from a reputation and employee engagement perspective. However, that is going to change under the bill. Under the bill, the ability to use fire and rehire is severely restricted. Essentially, what the bill will do is make any dismissal automatically unfair where the reason for the dismissal is that the employee does not agree to the employer's attempt to vary their terms and conditions of employment, or because the employer intends to employ another person on varied terms to carry out substantially the same role. So it's extremely narrow. There is one very limited exception, and that is which will allow employers to use fire and rehire, so dismissal and re-engagement, but only where they are acting in response to severe financial difficulties which affect its ability to carry on its business as a going concern. There are some changes to family rights, which are the positive. So at the moment, there's no general statutory right to bereavement leave, that is, unless an employee's child dies before the age of 18 or is stillborn after 24 weeks of pregnancy, whereby statutory parental bereavement leave and pay may apply. There's also, of course, a right to unpaid reasonable time off for family and dependents in an emergency. But the bill will give the government the power to introduce a day one right to at least 1 week of bereavement leave for employees. The bill also intends to remove any length of service requirements for employees to take either paternity leave or parental leave. So at the moment, in order to take parental leave, an employee has got to be employed for a year, and to take paternity leave, an employee has to be employed for 26 weeks by the end of the 15th week before the baby is due in order to qualify for it. And then before I move on, I just wanted to touch on the recent case of 4 Women Scotland and Scottish ministers. I'm sure lots of you have read about it in the press. So this is a case that as a team, we are receiving a lot of questions concerning it, particularly around practical implications, including changing toilet and washing facilities. So I just wanted to touch on it today. So the case was brought by the feminist organisation 4 Women Scotland against the Scottish Government, and it concerned gender representation on Public Boards Scotland Act, which aimed to increase female representation on public boards. The Scottish Government issued guidance that sought to include trans women with gender recognition certificates within the legal definition of woman for public board representation. So 4 Women Scotland disagreed with that, and the core issue in the case therefore was whether the definition of woman should include trans women. 4 Women Scotland argued that it should not. Scottish ministers argued that it should. The case went all the way to the Supreme Court, and in April the court ruled in favour of 4 Women Scotland. So it ruled that for the purposes of the Equality Act, the definition of man, woman and sex refers to a person's biological sex and not a gender recognition certificate. The key implication was that a person with a gender recognition certificate does not change their sex for the purposes of the Equality Act, and it is just for the purposes of the Equality Act. So therefore a trans woman is a biological man and a trans man is a biological woman when considering the application of the Act. The court was very eager to emphasise that transgender individuals remain protected, as the characteristic of gender reassignment is protected under the Equality Act. But what the ruling has done is give rise to a number of practical implications for employers, and the EHRC has issued new guidance on toilet washing and changing facilities in the workplace. So what that guidance says is that, in summary, it's the requirement for employers to provide sufficient single-sex toilets as well as sufficient single-sex changing and washing facilities where these are needed. However, where facilities are available to both men and women, obviously trans people should not be put in a position where there are no facilities for them to use. The guidance says that mixed sex toilet washing or changing facilities should be provided in addition to sufficient single sex facilities where possible, albeit where facilities are in single lockable rooms, so not cubicles, but discrete lockable rooms, which are intended for single use, then they can be used by all. Thank you.
All right. Thank you, Sophie. Right, to bring us home, we're going to talk about salary sacrifice and saving us some money. Stephen, how are you going to save us some money?
We're trying to end on a positive note after all the discussion around tax and compliance and increased costs. So salary sacrifice, like IR35, is nothing new. It's been here, almost 30 years now, and I suspect most employers will be familiar with the concept of it. It's sometimes called salary exchange or other names, but effectively what we're doing is replacing taxable salary with usually a tax efficient or a tax exempt or a lower tax benefit in kind. The most common form of salary sacrifice that we see is around pensions, and pension salary sacrifice is an effective way that employers and employees can save towards their old age retirements and do it in a tax and an NIC efficient way. Employee contributions, if you don't have a salary sacrifice, they attract tax relief but not NIC relief. So employer contributions into the pension fund, tax and NIC relief, but employee pensions contributions only tax. So by putting in place a salary sacrifice for pensions, you are effectively making it a employer only contribution. The employee is giving up proportion of their salary that's equal to the amount that was being contributed to the pension fund by themselves, and the employer in return is making an enhanced contribution to the total value of the employee contribution and the previous employee contribution. The net result is that you're saving both tax and NIC. So because of the April increase in national insurance that came in, quite a lot of employers have re-looked at salary sacrifice, particularly around pensions, but also other forms of pensions, such as pension top-ups or additional voluntary contributions. They can be structured again via salary sacrifice. Salary sacrifice is actually rooted in Sophie's area of specialism. It's an employment law concept. It's a variation to the terms and conditions. So as long as it's implemented correctly, it will attract tax and NIC relief. HMRC did publish a paper last month. Understanding attitudes and behaviours of employers towards salary sacrifice of pensions was the full title of it, and it was a rather large research paper, and employers were incredibly positive about their experiences. And a lot of the questions we get is this just a prelude? Is this an intro to HMRC withdrawing pension salary sacrifice? Some of us did fear that around about the time of the budget, and they didn't go that far. And I suspect in the world we live in now, where people are living longer and not saving enough, any changes to salary sacrifice for pensions would not be well received by employers or employees. And the research paper that HMRC published did sort of conclude on that basis. It said it's likely to actually create a disengagement of people around their pensions. So, don't quote me yet, but I'd be very surprised if they did change the rules around pension salary sacrifice. There are other forms as well. There's holiday buyback, which is the ability to buy and sell annual leave. You can flex your holiday allowance. Maybe you get 25, but you want to buy some extra ones. You can do that, because if you're buying extra days, you're reducing your taxable and nickable pay. Again, as long as it's sort of rooted in employment law correctly, you can do that, and it will create a saving. The humble cycle to work scheme has been there a while now, but also electric vehicles. If you want to buy, a low CO2 or a fully electric vehicle, you can do that still in a rather efficient way. Effectively, it's a form of HP, but it's structured via the employer, who can usually tap into some quite generous wholesale discounts. And you can write into the rules what happens if the employee leaves too soon. So as a company, you're not left with a forecourt of electric vehicles. So the employee will always have the ability to, give back the car or take on the borrowing for it as well. But I suspect, because the drive towards net zero and wanting to get us all driving more fuel efficient cars, that this is how it's going to happen. This is what's going to bring about this change, doing it in a sort of tax efficient way in the tax system, and salary sacrifice for electric vehicles. It's one of the permitted forms of SALSAC, because the Revenue introduced some rules 7 or 8 years ago called OPRA, the optional remuneration arrangements, where they effectively said, if it's not one of these forms of salary sacrifice, we are going to tax the higher of the cost of the benefit or the amount being sacrificed. So that closed quite a lot of legacy schemes down, but these ones have been ring fenced. So that's what we mean around salary sacrifice as a form of cost reduction, to sort of manage those increased costs that came in from April. I'm going to touch on one or two other points here before we sort of hit the hour. There is the opportunity to potentially seek a reclaim of NIC if you are an employer that pays car allowances to staff, and you've been operating NIC. HMRC have lost a tribunal with the Lang O'Rourke company around the definition of relevant motoring expenditure, RME, and that wouldn't be subject to NIC. So if you've historically paid car allowances and you've got people who are claiming business mileage for that, we could potentially work with you to look at getting some money back from HMRC, and those cases are still there and they're open. HMRC haven't yet challenged it through the courts or tribunals, so there's still potentially an opportunity there. But we also do things like expense reviews and looking at optimization around reliefs and exemptions that are there, and are people overpaying or not claiming reliefs where they potentially could. We're doing a lot of work around salary versus dividend planning at the moment, particularly because of that increase in the employment allowances, and directors of closed small companies or owner managed businesses. What's the proportion of salary? What's the proportion of profit by dividend that you want to extract from the company in terms of that planning? We do quite a lot of work of that at the moment in terms of forecasting. bonus waivers is very much linked to salary sacrifice. If you know what a bonus is going to be at a certain date and you wish to waive your entitlement to it, you can direct that bonus is paid into your pension free of tax and free of NIC, as long as it's waived prior to your entitlement to receive it and it's documented. That is a tax effective way of managing it, again subject to the annual allowance around pension contributions and ensuring it ties in with all the other reliefs that are on your tax return that you might be claiming. I'm conscious of time, so at this point I will hand back to Tony to bring us to a close.
All right, well, we were going to cover terminations, and I'm sure Sophie would have had plenty to tell us, but maybe we'll save that for another day. But I guess I'm going to throw a couple of quick questions at your team that have come in. Trivial benefits, Sean, £50 you sold us. Is that including VAT or excluding VAT?
Yes, that's inclusive of VAT.
Right. And Jay's asking, if a benefit like private medical is taxed via payroll, do you still have to issue a P11D?
So there's no P11D issued, but you will still be required to issue a P11DB. So the total amount that has gone through payroll will need to be included on the P11DB, and the Class 1A NIC paid through that way.
Thank you very much. The final question, is giving charity a salary sacrifice, Stephen?
If it is structured correctly, usually by something called a Give As You Earn, GAYE scheme, then yes, it can be via a salary sacrifice, but it normally needs to be through an approved bureau, not just setting it up willy-nilly. So you partner with a third-party organisation, but yes, it's effectively giving the relief that's around gift aid to employers to donate, but again, making sure it's structured correctly under that Give As You Earn scheme.
Okay, and I guess all that leaves is for me to say thank you very much to our presenters, to Stephen, to Sean, Sophie. It's been a real pleasure having you on board. Thank you for joining us today. As I mentioned before, we will send out a copy, both of the slides and a link to this recording. If you missed a bit or just love the sound of our voices, you can listen to it all over again. Thank you for your questions. There's a couple I'm sorry we didn't have a chance to answer. We'll take a look at those offline, as it were. You have all of our contact details there, so if there's anything you want to follow up from today's webinar, or if you need assistance on any of the matters we've raised, we'd be delighted to hear from you. And also, if you've got any topics you'd like to suggest for a future webinar, we'd also welcome your suggestions. So for now, let me just say thank you to all of you. Let me also say thank you to Dave and Lola, who work so hard in the background, and thank you for all of us for joining us in, I think, record numbers today. So it really is great to have you on board. We'll be back soon, but for now, thanks from me, Tony Newgrosh. All the best, and we'll speak to you soon. Cheers now. Bye-bye.